Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Matt, the mortgage guy. How you doing, buddy?
I'm doing great, Mike. It's great to be on with you. You were traveling for Thanksgiving the week before. I think I was doing continuing education, so it's been a few weeks, man. I missed you.
I missed you as well. So I got to tell you, you've had a good 3 weeks. We got interest rates are down 3 weeks in a row. 30-year average, according to mortgage bankers, was 6.49, down from the low sevens. So that's got to feel good. FHA just raised loan limits over $1 million in high priced areas. Um, what else do I got?
I
Purchase
mean,
apps were up 4% week on week. So again, there's a lot of stuff going on in housing. Rates under 6.5. That's going to bring some people back. What's going on?
yeah, I mean, and the data proves it, right? Where it's like me and you can guess, and then you can say, look, rates went down, mortgage applications went up. Like the data is there. And me and you have talked about this before. Those numbers will increase significantly under 6%, under
Six is the
5.5%.
number. Six
Yeah.
six is the number, man. For me, that I think that's game changing. Is 6%.
Right. I agree with you because, I'm talking to these folks every single day. And with as volatile as rates have been and this big tick up, it's interesting to watch consumer behavior, because what happens is rates are low for a long time and like, oh, no reason to do anything. We saw earlier in the year, rates started to tick up and people said, oh shit, went from on the sidelines to in the game because
Right.
they don't want them to. And now that rates have been higher for a little bit, any dip down is like, oh, maybe I should get
Right.
involved. Maybe I should
Give
go
me
out
some of
there.
that.
Right. And so it'll cause folks to jump off the fence. And it's an affordability thing too. For California, where I do a lot of business.
Yeah.
The 0.5% difference in rate when you're buying $400,000, $500,000, $600,000 homes and higher, honestly, in a lot of areas, that 0.5% is hundreds of dollars per month,
Yeah.
which makes the difference between like, do I buy something and lock into $2,900 a month, or do I sign another 1-year lease at $2,800 renting?
Exactly.
And so I totally agree. If things happen where rates come down under 6%, no doubt a lot of demand comes back into the market. And that, as we know, supply and demand is an important factor for what prices are going to do. I told somebody on an interview recently that like rates are going to affect demand, and demand is going to be one of the main factors creating a floor, right? Where anybody who thinks that home prices might go down 20 or 30%, not going to happen.
Not nationally.
Especially if we get this floor created because some demand comes back in. And you and I know that, like, where's this glut of inventory? It's not coming.
That's the rub, right? I've talked about this for a year now and been right to this point. It could change, but we saw demand destruction as rates went up from 3 to 6. That was clearly demand destruction. Now from 6 to 7.25 or whatever they were, we started to see supply destruction. Most people do not understand the amount of supply destruction that has happened, right? This whole move up market dead, luxury dead. I mean, it's just dead. And you're right. What we're seeing now is inventory is crashing. I had a bet with a Phoenix agent, John Wake, I believe his name is. He was telling me, I think back in September, that Phoenix, Arizona specifically was going to skyrocket inventory, blah blah blah. And I said, I got it on record, and I just tweeted him yesterday because I took a picture of it on my whiteboard. I'm like, how's that inventory now? He's like, it's down. You were right. I'm like, yeah, because Phoenix is unique because of iBuyers. It was a distorted market. And Redfin or Zillow, thousands of units, but they stopped buying. So that supply will eventually come off. Most of the country, supply is down. Nationally speaking, supply is down.
Right. And that's the thing too. Sacramento is a market that saw this big run up and we saw inventory increase. We saw stuff sitting on the market for longer, but we're well past the peak of inventory. That was August. Yeah, it's been coming down since August.
Exactly. Because you were going to see some distortion. Sacramento had some iBuyers, and that distorted it on the up and distorted on the way down. And right now you got a bunch of people that, hey, I got my home. I've been to 3.1%. I'm not selling. Even if they get laid off, the whole next thing is layoffs are going to come and people are going to sell their homes. Where are they going to go? Right? They're probably mortgage payment for most of them is below rent. They will find another job. We're not
well
going to go
below rent. Well below rent.
So they're not going to go somewhere.
The 20 and 21 where 70% of people refinanced into, sub 3.5 or whatever the stats say, those people have $2,000 mortgage payments in a market where rents are 2,800. And if you bought something at the same price at today's rates, 3,500, they are like
not going anywhere,
no matter what they have to do to stay. They've got equity, they've got a low rate, they are not moving. And so, I talked to someone recently too about the whatever that fancy word is for how long people stay in homes. That will continue to go up.
Oh, it's going to go up. It was averaging 8 years. It'll go up to 10 or 11. The other thing to realize is I don't think we get back to 6 million transactions probably until 2025. Right. We had been over 6 million transactions for most of the last decade. And I think supply and demand destruction are so bad, specifically supply, which nobody talks about. We won't see 6 million transactions again unless rates get under 4.5. Rates get under 4.5, maybe that move up buyer, comes back. But I think it's years before we see 6 million transactions again. What do you think?
Yeah, I think you're right. And I think that you were probably one of the only ones saying we might do sub 4 million next year. And, this is something too, where no matter how well we are able to gauge things, it's going to depend on interest rates, because interest rates drive demand. The monthly mortgage payment, talk to thousands of people every single year. This is what drives consumers. If rates come down, maybe it's 4.1. If rates stay high, like sub 4 million is likely. And for anybody listening that's trying to get a grasp for like what that means, we did 7 million transactions when we had steroid injection in 2021, right? So this is a drastic reduction from what we've seen. And you're probably right. If it's 4 million ish in 2023, depending on where rates go, that might go to the mid fours, 2024, and we're gonna have to see some demand increases in a significant way to get back above 5 million.
Yeah, we're going to be sub 6 million transactions for years. Last thing I want to talk about, video number one with you, is something you brought to us a month ago, was that FHA was going to be raising their limits, and not only their conventional, but also their high dollar amount. I heard a crazy number that they're over $1 million now. Federal back loans at $1 million. Crazy.
At $1 million. Yeah. And this is something too, that like the one rental at a time community is a smart market. So I can explain to them. We had about, a month ago, all the lenders come out and say, we're going to honor up to 715,000, guessing what it was going to actually increase to. But not until November 29th, when FHFA, who's, Fannie Freddie conventional loans, said, here's our official number for 2023. Now it's official. And it actually came out higher than the 715 that lenders had guessed. And even in the last 3 weeks, Mike, we had lenders that were backing off of the 715, saying, yeah, we're still going to honor up to 715, but between 700 and 715, it's more expensive, because they weren't sure what was going to happen. But Q3 of 21 over Q3 of 2022, that's what they look at. And they look at, their metrics for how much home prices have increased. That number ended up being 12.21%. They take the old limit, 647,200, which is a national limit for conventional conforming loans, multiply that times 112%, 0.21. So 726,200 across the country, Fresno County, all the, any county out there. Then you get into high cost areas, and, Sacramento, where I do a lot of business, goes up to 763,600. They call it a high balance loan. And then depending on county, this can go all the way up to the maximum. And they set the maximum of 150% of that 726,200 limit. So San Francisco, Santa Clara, Los Angeles County, high cost counties, $1,089,300 is the limit there, where you can get a conventional conforming loan someone's going to buy for 1.3 million and put 20% down and not be in a jumbo loan. That's pretty wild to think about.
Wow. So again, conventional, for folks that don't know what that is, that's 20% down.
Well, conventional, you can put 3% down.
Oh,
So,
three.
so,
Okay.
so that is where I honestly think that that's probably, when somebody is buying something for 1.3 million and putting 20% down, pretty well to do, pretty well qualified. They probably don't have an issue getting a jumbo loan. It's just going to be a little bit tougher, more stringent underwriting. Some jumbo lenders will want 2 appraisals. Just the toughness or the extra guidelines involved with the jumbo, you'll avoid that by being able to go conforming. But I think the thing that is probably going to be more impactful for buyers is you're buying for 750 and you're looking to put 3% down. This is something, I don't know if me and you talked about it, but 3 and 5% jumbo was around 9 months ago. It's vanished. And I've had people reach out to me where almost every single investor has got 10% minimum for jumbo loans. If they have 5%, it's grossly expensive. And so first time buyers, some people across the country are going to think to themselves, oh my gosh, 750, 800,000 is a ludicrous number. In California, it might be a 3-bedroom, 2-bath, 1,100 square feet.
It might be a 3-1. What are you talking about?
Yeah, 2-1. And so those buyers with the smaller down payments get to follow the same rules as 3% down on a $200,000 purchase, 5% down on a $200,000 purchase. And so as home prices increase, they increase this limit. And high balance counties, almost a $1.1 million loan amount is going to be a conforming loan.
Yeah, and I guess the last thing to think about is, do you think this has any impact on increasing the floor in some markets? Some people talk about this increasing prices. Instead of saying that, does it make the floor a little more firm in some markets?
What do you mean by that?
Like, let's just say there was a market that was going to go down 3 or 4 or 5%. This high dollar bound or whatnot comes in and allows people to get into a conventional loan at this new limit. Does this higher loan limit affect price at all? And I don't know if it does.
You know what? It might. And when I think about markets that are suffering or going to suffer, the Bay Area comes to mind, right?
Yeah,
where
for sure.
If Amazon and Meta and everybody lay off tens of thousands of folks and
it's going to hurt.
It's going to hurt demand in those specific markets. And maybe, the entry level of those markets, I've done a lot of them, right? And when we mention a 3-1 for 1.2 million, that's,
Santa Clara.
San Jose type market, Santa Clara type market. And so maybe it does help that floor, because somebody who couldn't get into a jumbo, they didn't have 10% down, they didn't have a couple $100,000 in the bank, because jumbo will also require reserves on top of the down payment. Maybe it does create a floor, because then, someone who's able to buy at 900 and put some money down or whatever is going to help create that floor. So that's a good point, Mike. And maybe it does. I don't know for sure.
Yeah, I don't know either. It's just, again, you raise the loan limits, you got to think about the marginal buyer, right? It's all about the marginal buyer. Do they get pulled in or not? So it's fun to think about. Matt, where can people reach out to you and follow you?
Go to greatmortgagebroker.com, fill out a form. That's if you're trying to get pre-approved with me and the team. If you just want to follow and mortgage education and hear my advice from talking to thousands of realtors and investors and home buyers every single year, Matt the Mortgage Guy on YouTube. I've got stuff on Instagram and TikTok and everywhere else, but YouTube, I think, is where the bulk of the education lies. So come subscribe and say, I'm here from Zuber. I get that all the time. People like, found you on one rental at a time. I'm here to check you out.
Very cool. I appreciate you. Yeah, give him a follow. Puts out a lot of great stuff, and also put in some content for my course, How to Get Started One Rental at a Time, which people love. Thanks, bud.
Thanks, Mike.